I won't allow you to waste your valuable time here. Come, let's go and see today's interesting topics. 30 do's and don'ts of stock market investing for beginners. If you've ever been curious about investing and didn't know where to start, you've likely pondered a variety of questions. From what types of stocks to buy, to how much money to invest, to who to ask to guide you along the way. Do's and don'ts of stock market. Making money from stocks is simple if you strictly follow the do's and don'ts of stock market investing. For example, the first and foremost rule to invest intelligently in stocks is to not speculate, but invest only after proper research. However, most people speculate in stocks and bet that the share price will go high in the upcoming days without any significant analysis. In this video, we are going to discuss the do's and don'ts of stock market investing for beginners. Let's get started. 30 do's and don'ts of stock market investing for beginners. Do's of stock market investing. Here are a few of the do's of stock market investing that every investor should follow. 1. Research is the key. Many investors complain, "I invested in this stock based on tips, but know anything about the company's business. The market wobbles. The share prices go down a bit and investors tremble." This is due to a lack of proper planning and improper research about the fundamentals of the companies they had invested in. Check the company's business details, financial statements, ratios, management, and more before deciding whether its shares are worth your money and time. 2. Educate yourself. This is probably the most relevant do's of stock market investing. If you really want to become a successful stock investor, start learning the market. It doesn't mean that you should enroll in a college program, degree. Self-education is the best way to learn. There are tons of free information available on the internet which you access to learn about the market. Moreover, if you want to get a head start, you can also enroll in a few good online stock market investing courses. Let the learning begin. 3. Research before investing. One of the key reasons why people do not make money from stocks is that they do not put in the initial efforts before investing in the share. Every investor needs to research the company before investing. Here you need to learn the company's fundamentals, financial statements, ratios, management, and more. If you do not want to regret it later, research the company first before investing. 4. Invest consistently. Most people get excited and enter the stock market when the market is doing well and the indexes are touching new highs. However, if you only invest in a bull market and exit when the market is down when stocks are selling at discount, you will never find fantastic opportunities to pick cheap stocks. Do not invest in the market just for a year. If you want to make good money from stocks, invest consistently and periodically increase your investment amount. 5. Have patience. Most stocks take at least 1-2 years to give good returns to the investors. Moreover, the performances get better when you give more time. Have patience while investing in the share market and do not sell your stocks too soon for short-term gratification. 6. Invest for the long term. It's true that many investors who have become wealthy from stocks are long-term investors. Long-term investing is more stress-free and gives investments time to make a greater impact. Investing for the long term can help you avoid paying numerous fees to your broker for opening numerous trades. Also, thanks to compound interest, you can earn more over the life of your investments by investing less now than a larger amount later. 7. Diversify. Do not put all your eggs in one basket. The risk involved while investing in just one stock is way higher compared to a portfolio of 10 stocks. Even if 1 or 2 of your stocks starts performing poorly in the latter scenario, it may not affect the entire portfolio too much. Your stock portfolio should be sufficiently diversified. 8. Invest for the long term. It's a common fact that all the veterans of the stock market who made an incredible fortune from stocks are long-term investors. But why does long-term investing helps to build wealth? Because of the power of compounding, the 8th wonder of the world. If you want to build massive wealth from the market, invest for the long term. 9. Hold the winners, cut the losers. Cut your losing stocks if they underperform for a long time and hold your winning stocks longer to allow them to offer even better returns. This is the golden mantra of investing that you should strictly follow. Moreover, keeping your winners and cutting losers will also help in building your dream portfolio. 10. Only invest what is surplus. The stock market gives an immense opportunity to invest in your favorite companies and make money. However, there are always a few risks involved in the market, and no returns are guaranteed. Moreover, many times a bad may even last for years. Therefore, you should only invest the surplus money which does not affect your lifestyle even if you can't get it out. 11. Get started early. I cannot emphasize enough the importance of getting started soon with your finances. Time is in your favor when you start investing early. Moreover, here you get enough time to recover even if you make some losses during the early time of your investment journey. 12. Average out. If you've done it, you might be lucky. A better approach here is to buy, sell in steps. 13. Diversify your portfolio. New investors might be surprised to know that it's better to own more investments than less. A diversified portfolio should not only be varied in its number of investments but also in types of investment. In the event that one or two of your stocks begin performing poorly, it may not affect your entire portfolio greatly. This is just one reason why your stock portfolio should be sufficiently diversified. Don'ts of stock market investing. 14. Don't overtrade. When you are trading frequently, you are repeatedly paying for the brokerage and other charges. Don't buy, sell the stocks too often. Make confident decisions and make transactions only when necessary. 15. Don't invest blindly on free tips, recommendations. The moment you open your trading account, you'll start getting free messages on your phone with BUY/SELL calls. But remember, there is no free lunch in this world. Why would anyone send a stranger free tips for multi-bagger stocks? Never invest blindly in free tips or recommendations that you receive, no matter how appealing they may sound. 16. Don't have unrealistic expectations. Yes, many lucky guys in the market have made 400,500% return on their single investment. However, the truth is that these kinds of news get quickly circulated. Have realistic expectations while investing in stocks. A return between 12–18% in a year is considered good in the market. Moreover, when you compound this return over multiple years, you will get way higher returns compared to 3.5% interest on your savings account. Further, do not assume that you can get the same profits as others, who might be investing in stocks from many past years and may have acquired an amazing skill set. You can also get similar returns, but only after enough knowledge and practice. 17. Don't follow the herd. Your colleague purchased a stock and made 67% returns from it within a year. Now, he's boasting about it, and many of your office mates are buying that stock. What would you do next? Should you buy the stock? Wrong. No investor can get significant success from the market by following the herd. Do your own research rather than following the crowd. 18. Don't make emotional decisions. The human mind is very complex, and there are many factors both internal and external that can affect the choices we make. While investing in the stock market, do not take emotional decisions. No matter how much you like a company, if it is not profitable and doesn't have a bright future potential, it may not be the right investment decision. Do not get emotional while making your investment decisions. 19. Don't take investing as gambling. Let me repeat this in simple words: investing is not gambling. Do not buy any random stock and expect it to give you 2 times return in a month. Since your money is at stake, investing has been known to affect your emotional well-being. That's why it's important to keep a level head when investing, as emotions can cloud your judgment. It's best to only invest when you are sure it is the right thing to do and have an exit strategy in mind. 20. Research is the key. Many investors complain, "I invested in this stock based on tips, but know anything about the company's business." The market wobbles. The share prices go down a bit and investors tremble. This is due to a lack of proper planning and improper research about the fundamentals of the companies they had invested in. Check the company's business details, financial statements, ratios, management, and more before deciding whether its shares are worth your money and time. 21. Holding on to stocks. Many people dream of earning huge profits from the stock market without realizing how trading and investments necessitate discipline and being heedful of volatility. Not realizing possible outcomes or stock market movement in the future, many investors attempt averaging down the investments made. This causes them to hold to their stocks for an extended period. The inability to book profits whenever possible has caused many investors lose capital and book unwanted losses. There is a need to have a financial goal in mind so that you may make proper calculations to hedge yourself from maximum losses. 22. Start investing early. The best time to invest in the share market is when an investor is young and can afford to take risks. Young investors can take more risks and recover from wrong decisions without affecting their long-term financial goals. When you start investing in stocks early, you can get better compounding benefits from reinvesting dividends. One can even start investing in small amounts. You can start investing in the stock market for as little as 500 rupees. 23. Know your risk profile. Knowing your risk profile before investing and creating your stock portfolio is important. It is easier to find the right mix of high-risk, high-return assets and low-risk, low-return assets when you understand your risk profile. A risk profile is measured according to your risk tolerance, risk capacity, and risk requirements. Risk tolerance is how much risk you are willing to take. Risk capacity is how much risk you can take based on your financial situation. Risk requirement is the amount of risk you need to take to reach your financial goals. If you already have built a portfolio, you should check if your investments match your risk profile. 24. Focus on the big picture. Have an investment goal and plan in mind before stepping into the market. Decide your stocks depending on whether you wish to accumulate a huge corpus within the next 10 years or want to create a retirement fund. Some stocks are evergreen, so you can buy them in small lots during dips to create a valued legacy. Besides, with regular dividends and sporadic returns on the shares, the motivation is high, thus setting the much-needed pace for the growth of your investments. Setting a financial goal will encourage you to review your planning and decide on a sound and prolonged capital strategy accordingly. 25. Don't invest based on psychological biases. Psychological biases like loss aversion, Overconfidence bias, anchoring bias, and herd behavior bias can get in the way of creating a suitable stock portfolio. All investors have to work through their own biases in investing. Sometimes investors may react too much to short-term losses or be too confident in stocks that are losing money. These are examples of psychological biases in financial investment. Behavioral biases can be dealt with by sticking to a sound investment strategy. 26. Don't gamble. People should keep their gambling instincts aside when making investment decisions. Instead, investment decisions should be made purely based on credible information. Instead of taking unnecessary risks, you should try to develop sound strategies. Activities like taking free tips, betting huge sums on short-term movements, or using your emergency funds for short-term trades are akin to gambling on the stock market. 27. Don't trust free tips. Price manipulators often spread misinformation to fraud unsuspecting investors. They may try to lure investors through free investment tips. Investors should always try to verify the source of their information. In addition, not paying attention to investment advice posted on unregulated Discord servers, Reddit channels, or any messaging boards would be wise. Limiting the information you consume is a good way to sidestep misinformation. Free investment tips in the share market are not always easy to identify. Sometimes, these tips may be given by social media influencers, or they may be presented subtly so that investors do not get spooked. 28. Invest only with your surplus funds. Before investing, you should always consider the necessary expenses like rent, living expenses, insurance premiums, EMIs, etc. The leftover from these expenses is called surplus funds. Investment of surplus funds is safer as you won't miss out on important expenses. People often say, invest only what you can afford to lose. Stock market investments are subject to market and business risks. There's no need to let these risks affect your lifestyle. 29. Don't keep unrealistic expectations about investing. It is harmful to keep unrealistic expectations about stock investments. Suppose you expect high returns even before doing research. In that case, you might limit yourself to investments with high expected returns and hence high risks. Ideally, you should learn about the market conditions, select sectors to invest in, and find the expected returns on investments on stocks in those sectors. After all this, you should create the stocks portfolio that suits you. Expectations play an important role in investing. 30. Don't invest based on psychological biases. Psychological biases like loss aversion, overconfidence bias, anchoring bias, and herd behavior bias can get in the way of creating a suitable stock portfolio. All investors have to work through their own biases in investing. Sometimes investors may react too much to short-term losses or be too confident in stocks that are losing money. These are examples of psychological biases in financial investment. Behavioral biases can be dealt with by sticking to a sound investment strategy. Final thoughts. Various opportunities and threats will present when you start investing in stock markets. You should practice habits like trusting information only from credible sources. In addition, it is helpful to pay attention to your mental and emotional well-being and build an investing mindset free of psychological biases. We have listed various do's and don'ts in this article. Still, investors should always keep learning and update themselves about what's happening in the stock market. I tried to cover the do's and don'ts of stock market investing for beginners. However, this is just a guide and not a manual. You will learn more do's and don'ts through your personal experiences when you start investing on your own. I hope this video on do's and don'ts of stock market is useful to you. Stay tuned. Thanks for watching the video. We will cover more details in upcoming videos. Stay tuned. Thanks for watching the video. Our mission is to provide a relaxing experience to our viewers with content that focuses on the natural beauty that our world provides, and we will try to cover cooking videos for cooking lovers and sharing many delicious recipes. And some motivational videos, motivational speech, motivational quotes. We bring out the collection of best audio and video. We make most powerful videos on daily basis. Your kind support will be a great motivation and inspiration to my creation. Please subscribe, like and comment, as I do my best to upload quality videos. Thank you. Don't forget to press the notification button to see the next video.